price on your screen says one thing, the price in Tokyo says something completely different. And the gap between them just crossed a threshold that has never happened before in the history of commodity markets. This is not a glitch. This is not a temporary arbitrage opportunity. This is the moment when two realities that were supposed to be the same start pulling apart. And the distance between them is widening every single day. One price is what the system tells you silver is worth. The other price is what people are actually paying when they need real metal in their hands. And the difference between those two numbers is the most important signal in the silver market right now, because it is telling you something the official price cannot. It is telling you the paper market is losing control. Let me show you exactly what is happening. Right now, silver on Comex, the official exchange, the place where prices are supposed to be set, is trading at $116 per ounce. That is the number you see on financial websites. That is the number Bloomberg reports. That is the official price. But in Tokyo, physical silver, actual metal you can hold, is trading at $140 per ounce. In some cases, higher. That is a $24 gap, a 20% premium over the official price. 20%. Now let me be very clear about what that means. In normal markets, arbitrage keeps prices aligned. If something is cheaper in one place and more expensive in another, traders buy where it is cheap, sell where it is expensive, and the prices converge. That is how markets are supposed to work. Price differences get erased by people moving the product from low price areas to high price areas. It happens fast. It happens automatically. It is the most basic function of global trade, but it is not happening with silver right now. The gap is not closing, it is expanding. And that tells you something fundamental is broken. Let me walk you through why this gap exists. Because once you understand the mechanics, you will see why this is not just about Japan. This is about the entire structure of how silver is priced. The Comex price is a paper price. It is based on futures contracts, promises to deliver silver at a future date. Most of those contracts never result in physical delivery. They get rolled forward, they get cash settled. They exist in the financial system as price exposure, not as actual metal. And because most participants do not want the metal, because they are just trading the price movement, the paper market can function with far less physical silver than the number of contracts would suggest. The ratio right now is somewhere around 356 to 1. 356 ounces of paper claims for every 1 ounce of real metal. That is not my estimate. That is based on open interest versus available registered inventory. So the Comex price reflects what traders think silver should be worth in a world where most people are just betting on the direction, not demanding actual metal. But Tokyo is different. Tokyo buyers want physical silver. They need it for manufacturing, for electronics, for industrial use. They are not speculating. They are buying metal that will get used and consumed. And when they go to source that metal, they are finding that supply is tight, very tight. So they pay more. They pay premiums over the spot price. Because if they do not secure the metal now, their production lines stop. This is where the two realities diverge. The paper price assumes unlimited availability. The physical price reflects actual scarcity. And right now, those two assumptions are creating a $24 gap. Now, let me show you why this gap is not limited to Tokyo. Because the same pattern is showing up in other markets. Dubai. $165 to $170 per ounce for physical silver. Seoul, premiums above spot. Shanghai, not even accessible to Western buyers, but reported prices well above Comex. This is a global phenomenon. Everywhere people are trying to buy real silver, they are paying significantly more than the official price. And here is what should terrify anyone who understands how markets work. Arbitrage should be closing this gap. If silver is $116 in New York and $140 in Tokyo, someone should be buying in New York, shipping to Tokyo, and pocketing the difference. That is a $24 profit per ounce. On a 5,000 ounce shipment, that is $120,000. Risk-free. Guaranteed. Except it is not happening. Or it is not happening fast enough to close the gap. Which means one of two things is true. Either the metal is not available to buy in New York at 116, or the cost. And restrictions of moving it to Tokyo are so high that the arbitrage does not work. Both of those explanations point to the same conclusion. The paper price is fiction, the physical price is reality. Let me take you inside what happens when someone tries to close this arbitrage. Because this is where the system starts leaking. You are a trader. You see the gap. You think this is easy money. You buy a futures contract on Comex at 116. You plan to take delivery, ship the metal to Tokyo, sell at 140. Profit. Step 1. You buy the contract. No problem. Paper is easy. Step 2. You demand physical delivery. This is where it gets complicated. Because Comex delivery is not instant. It is not simple. You need an approved vault. You need to pay storage fees. You need to arrange transport. And most importantly, you need the metal to actually be available. Registered inventory, the metal available for delivery, has been draining. It is under 100 million ounces now, down from over 300 million a few years ago. So when you go to take delivery, you might find that the metal is not there, or the delivery timeline is weeks out, or the vault is charging premiums for immediate access. Step 3, you arrange shipping. International transport of precious metals requires insurance, security, customs clearance, export permits, import permits, all of which add cost and time. And here is the critical part. If you are shipping from the United States to Japan, you are dealing with different regulatory frameworks, different reporting requirements, different oversight. Step 4, you arrive in Tokyo, you sell the metal. But by the time you have gone through steps 1 through 3, the premium might have changed, the spread might have narrowed or widened. You are exposed to timing risk. And even if everything goes perfectly, your margin after costs might be much smaller than the headline $24 gap suggests. This is why arbitrage is not closing the gap, because the gap is not actually arbitrage. It is a signal that the physical metal is not flowing the way it is supposed to. Now, let me show you what this means for price discovery, because this is the part that changes everything. For decades, the Comex price has been treated as the global benchmark. If you wanted to know what silver was worth, you looked at Comex. It was the reference point, the anchor. But if physical buyers in Tokyo and Dubai and Seoul are consistently paying 20 to 30% above that benchmark, what does the benchmark actually mean? It means the paper market is setting a price that does not reflect the cost of acquiring real metal. It means the official price is divorced from physical reality. And when that divorce becomes permanent, when the gap does not close, the entire pricing mechanism shifts. We are watching that shift happen right now. Physical markets are starting to ignore the paper price. They are developing their own pricing based on local supply, local demand, local availability. This is what traders call a two-tier market. One price for paper, one price for physical. And the two no longer converge. Let me give you a historical example, because this has happened before in other commodities. Gold in the 1970s. During the London gold pool era, official prices were maintained at $35 per ounce by central bank intervention. But physical gold was trading at premiums in certain markets. People who wanted real metal were paying more than the official price. Eventually, the gap became unsustainable. The London gold pool collapsed. The official price was abandoned, and gold started trading based on actual supply and demand, not artificial benchmarks. The price went from $35 to over $800 in less than a decade. Now I'm not predicting silver goes to $800. I'm showing you the pattern. When paper prices and physical prices separate and the gap persists, the paper price eventually loses credibility. And when that happens, price discovery shifts to the physical market, which trades at much higher levels. Here's what the data is showing right now. Tokyo premiums started appearing in late 2025. Small at first, a few dollars over spot, explainable by local demand, but they did not shrink. They grew. By the end of the year, premiums were in double digits. Now they are $24 and climbing. Dubai followed the same pattern. Premiums appeared, widened, stayed elevated. Seoul, same trajectory. This is not random. This is a coordinated signal across multiple markets. Physical silver is scarce, and the scarcity is not being reflected in the official price. Now add the China export restrictions. 70% of global refining capacity just got locked down. The largest source of physical supply is no longer freely available. That makes the physical shortage worse, which pushes premiums higher, which widens the gap further. We are in a feedback loop, and it is accelerating. Let me show you what happens next. Because there are 3 possible outcomes, and each one changes the market in a different way. Outcome 1. The paper price rises to meet the physical price. Comex traders see the premiums in Tokyo and Dubai. They realize physical is trading higher. They bid up futures contracts. The official price climbs to 140, 150, wherever physical is actually trading. In this scenario, the paper market adjusts to reality. The gap closes by the paper price rising. Everyone holding silver benefits. The market rebalances at a higher level. Outcome 2. Physical premiums compress. New supply comes online. Arbitrage finally works. Metal flows from low premium areas to high premium areas. Tokyo premiums shrink back to normal levels. In this scenario, the physical market adjusts to the paper price. The gap closes by physical coming down. The Comex price stays the benchmark. The system survives. Outcome 3. The gap persists. Paper and physical continue trading at different levels indefinitely. A permanent 2-tier market. Industrial buyers pay physical prices. Speculators trade paper prices. The two never meet. In this scenario, the Comex becomes irrelevant for anyone who actually needs metal. It becomes a casino for price exposure. Real price discovery moves to physical markets. Which outcome is most likely? Let me walk through the probabilities. Outcome 2 requires physical supply to increase significantly. But we just covered the China restrictions. Supply is not increasing, it is decreasing. So outcome 2 seems unlikely in the near term. The physical shortage is real. It is not getting solved by new supply anytime soon. Outcome 1 requires paper traders to acknowledge the physical premium and bid up futures. This is possible. It has happened in other commodities. But it requires a shift in psychology. It requires speculators to stop trusting the official price and start looking at physical. That shift is beginning. You can see it in the delivery data. More traders are demanding physical. Registered inventory is draining. People are losing faith in paper. So outcome 1 is plausible. The paper price could rise to meet physical, but it takes time, and it requires sustained pressure. Outcome 3 is what happens if outcomes 1 and 2 both fail. If supply does not increase and paper does not rise, then the gap just stays permanently. And in that scenario, anyone who needs real silver pays the physical price. Anyone who just wants price exposure trades the paper price. And the two markets operate in parallel. I think we are heading toward a mix of outcomes 1 and 3. The paper price will rise, but not fast enough to fully close the gap. We end up with a permanent premium for physical over paper, which means the real price of silver, the price that matters for industrial buyers, for people who actually use the metal, is going to be higher than what the screen shows, possibly much higher. Now let me address the question you're asking. What does this mean for someone holding silver? What does this mean for someone thinking about it? If you own physical silver, you are holding an asset that is trading at a premium to the official price in multiple markets around the world. That premium is not going away. If anything, it is growing. If you're thinking about acquiring silver, you need to understand that the price you see on your screen is not the price you will pay for real metal. Dealers are charging premiums. Delivery times are extending. Availability is tightening. The gap between paper and physical is not just a Tokyo problem. It is showing up in local markets everywhere. And it is widening. If you are trading silver futures, you are participating in a market that is increasingly disconnected from physical reality. That does not mean the paper price will not go up. It might, but it means the paper price is no longer a reliable indicator of what physical metal actually costs. Here's the part most people are missing. Because they see the Comex price at 116, and they think that is what silver is worth. They think the Tokyo premium is an anomaly, a temporary distortion. But what if it is the other way around? What if the Tokyo price is correct and the Comex price is the anomaly? Think about it. Tokyo buyers are paying 140 because that is what it costs to secure metal. They are not overpaying out of stupidity. They are paying market rates for scarce supply. Comex is trading at 116 because most participants do not want metal. They want price exposure. They are trading contracts that will never result in delivery. So which price is real? The price paid by people who need the actual product, or the price paid by people who are just betting on the direction? The answer should be obvious, but most people trust the official price because it is official, because it is on Bloomberg, because it is the benchmark. And that trust is about to be tested, because the longer this gap persists, the more people start questioning whether the official price means anything. Let me show you the timeline, because this does not resolve overnight. It unfolds in stages. Stage 1. Physical premiums appear in isolated markets, explainable by local factors. This happened in late 2025. Stage 2. Premiums spread to multiple markets. Pattern becomes undeniable. This is happening now. Stage 3. Industrial buyers start securing long-term contracts at premium prices. They stop waiting for Comex to reflect reality. They lock in physical at whatever price they can get. Stage 4. Investment demand shifts. People stop buying paper ETFs and start buying physical because they realize paper might not give them exposure to the real price. Stage 5. The paper market loses credibility. Comex volumes drop. Physical markets become the primary price discovery mechanism. We are between stage 2 and stage 3 right now, and the progression is accelerating. Here's what happens if we reach stage 5. If physical markets take over price discovery completely, the price of silver will be set by the balance of physical supply and physical demand, not by speculators trading contracts, not by algorithms, not by futures positioning, by actual metal changing hands. And in a world where supply is restricted by China, where industrial demand is growing, where stockpiles are depleting, that balance is deeply in favor of higher prices, much higher. Because the paper market has kept prices artificially low for years by allowing unlimited contract creation without requiring physical backing. But physical markets do not work that way. You cannot create physical silver out of thin air. You cannot print it. You cannot leverage it 356 to 1. Physical is real, and real is limited. Now, let me show you the signal that confirms everything I just told you. Lease rates. The cost to borrow physical silver. Right now, lease rates are elevated, significantly elevated, in some cases above 8% annualized. What does that mean? It means someone is desperate enough to pay 8% per year just to borrow silver temporarily. That only happens when supply is tight. When people cannot find metal to buy, they borrow it instead. And they pay premium rates to do so. High lease rates are a textbook signal of physical shortage, and they are flashing red right now. Combine that with the Tokyo premiums. Combine that with the Dubai premiums. Combine that with the China export restrictions. Combine that with the Comex inventory drain. Every single indicator is pointing in the same direction. Physical silver is scarce, and the official price is not reflecting it. Let me give you the conclusion. Because this is not complicated, it is just uncomfortable for people who trust the system. The price on your screen is not the real price. It is the price of a contract, a promise, a piece of paper. The real price is what people pay when they need actual metal, and that price is 20 to 30% higher than what the screen shows. The gap between those two prices is growing, not shrinking. And the longer it grows, the more it tells you that the paper market is losing control. At some point, the gap becomes so large that everyone notices. Industrial buyers, investors, governments, media. And when that happens, the entire pricing structure shifts from paper to physical, from Comex to Tokyo, from promises to metal. We are not there yet, but the pressure is building. The cracks are showing. The system is leaking. If this continues, the price will not be the real problem. The real problem will be trust. Trust in the benchmark, trust in the official price, trust in the idea that the number on your screen reflects reality. By the time that trust breaks completely, by the time everyone realizes the paper price is fiction, it will already be too late. The moves that matter happen now, in the gap, in the premiums, in the silence before the system admits it cannot hold. Someone is paying 140 in Tokyo right now. Someone is paying 165 in Dubai right now. Someone is securing metal at prices far above the official number. The question is whether you see it, or whether you trust the screen.